Many people have been talking about diversifying portfolio. Even if they are not financial professionals, they also know about diversifying portfolio, and they probably encourage you to diversify your portfolio as well. Diversifying portfolio may sound like a professional jargon, but what does it really mean, and why is it important for your portfolio? That's what we'll talk about today. Before you start investing, you might have heard of diversifying something. Diversifying your diet, diversifying your habits, diversifying your relationship, or even at the workplace, your boss also promotes diversifying in human resources. Apparently, the idea of diversifying has been around for years. There's even a well-known phrase for it: don't put all your eggs in one single basket. Since I'm making finance-related contents, we'll be talking exclusively about diversifying your financial portfolio. And for simplicity, I will use two companies to illustrate this idea. But before we begin, I have to explain two basic terminologies: expected return and standard deviation, or risk. Expected return is easy to understand. It's like how much you will get if you invest in something. If you invest $100 and you get back $120, then you have a 20% return. But before you get that expected return of 20%, your portfolio might experience a bumpy ride. It could be like this, or even like this. We call these fluctuations risk, and that is usually what investors have to either understand and accept, or entirely abandon and walk away, depending on your tolerance level. We can express these fluctuations using standard deviations, which describes how much the data points deviates from the overall trend. Let's start with an example. Suppose you have $50,000 at hand, and you want to invest in Company A. Company A has an expected return of 8% and a standard deviation of 12%. Then you can expect to get 50,000 times 8% equals $4,000. To estimate the risk, you can multiply your investment amount by the standard deviation of Company A, therefore 6,000. You can think of this $6,000 as something your portfolio can experience as a gain or loss in the process of obtaining that 4,000. Another common way to gauge the performance of Company A is to divide the expected return by the standard deviation, which can be interpreted as how much return you will get per unit risk. So the calculation will be $4,000 divided by $6,000 equals 0.67. Now, consider the case if you want to diversify your portfolio. For example, 25,000 in Company A and 25,000 in Company B. Company B has an expected return of 6% and standard deviation of 10%. Then you can expect the return if you invest equally in Company A and Company B be 7%. The formula of standard deviation for a combined portfolio will be this, which equals 9.5%. I know the process might already blow up your mind, so I don't want to bore you with all the details. But you see, compared with investing everything in Company A, investing in both companies would lead to a lower risk, from 12% down to 9.5%. Though you might argue that the expected return is 1% less. But if we divide the expected return by the standard deviation, we'll get 0.74, which is higher than 0.67 when you invest everything in Company A. That is the reason why generally it is good to diversify your portfolio. A diversified portfolio reduces overall portfolio risks and allows for higher return per unit risk. One thing worth pointing out here is, in the example that I showed you, I've secretly chosen the variable, the correlation between Company A and Company B, to be 0.5. Correlation measures the relationship between variables, indicating the strength and direction of their association. This value can range between -1 and 1, where 0 means basically they are not correlated. You can minimize the portfolio risk when correlation equals -1. Think of investing in sunglasses company and umbrella company, for example. Banks and hedge funds usually have models that capture the correlations for a wide range of assets, ranging from different sectors and from different countries, which provides them with quantitative insights for decision making. Don't worry if you don't have those fancy models, because I don't have them either. But here I can list 3-step approach for achieving a balanced portfolio. First, assess your risk tolerance. A higher return also accompanies higher risks, while lower return also has lower risk. Second, assess your knowledge about your assets. Invest in something you really know, and don't invest in something you don't really know. Well, that's very obvious. And lastly, invest in the wide range of sectors and from different countries. This way, you can reduce your overall portfolio risk. If you don't want to actively manage your stocks, then consider perhaps investing in the broad market index, such as S&P 500 or Nasdaq index. That's all for today's video. I hope you enjoy content like this. Don't forget to subscribe to Richer Than Yesterday if you want to improve your financial knowledge, and I'll see you in the next one.